Hello, everybody, and welcome. I'm Bonnie Halper. I write the weekly Startup One Step newsletter. I'll put the link in the chat. And every 2 weeks, we host an online investor insights with one. Today, we're honored having two investors and a self-selecting group of entrepreneurs, so anyone can join if you sign up fast enough. And I also help founders with their pitch decks and make introductions to investors or strategic partners where and when appropriate. And I am a super connector. I've been involved in this tech space since the early days of Web 1.0, so I know the players when they were starting their company. So I know where you guys are going to. I want to thank Joseph Katz for hosting us. Joseph, tell us about what you do.
Thank you, Bonnie. Welcome, everyone. Good morning. My name is Joseph Katz. I am a results-driven marketer. I've worked in both corporate America and early-stage tech. Seen the good, the bad, and the ugly of marketing. I basically help companies go from unknown to well-known with a focus on growth marketing and go-to-market strategies and plans. I'll put all my information in the chat. We keep the introductions short, so feel free to put your contact info in there as well. Looking forward to Joe and Glenn conversation today. We've had them in the past and always fun time.
Always a fun time. So our two guests today are Joe Milam from AngelSpan and Glenn Argenbright from Quake. And they're going to talk about the psychology of investors. So I don't know if you guys want to briefly introduce yourselves first, or you want the attendees to introduce themselves. We have attendees briefly introduce themselves so we know who's in the room. And then we'll open it to Q&A afterwards. So it's up to you.
Yeah, let the attendees go. That's my vote.
Okay. Adero, good to see you, and introduce yourself. Oh, you're muted and off camera. Okay.
Sorry.
Oh, there you go.
Good morning. I'm Adero. I am the founder of TrueBuy, which is an AI-enabled data transportation platform. So we're a B2B platform that solves congestion and various other issues using qualitative and quantitative data.
Oh, thank you. And everybody, feel free to put your contact information in the chat, or even, your website, what you're working on. Carol Donahue.
Yeah, sure. I'm a data scientist in Toronto. I work with mid-sized businesses for operations remediation, and in the startup space, AI integration into product.
Thank you. Andrea. And you're muted again, Andrea. She's always multitasking.
Oh, sorry. Yeah, hi everyone. Sorry, I'll be on camera in a bit. Andrea Liu, previously an attorney at immigration and corporate, but for the last 5 years I've been working for a Hong Kong family office, a bit of a generalist at a single family office across various verticals. Good to be here. Thanks, guys.
Always good to see you. Annie Wang.
Hi, morning all. I'm Annie and the founder of a influencer media agency called Influencers Powerhouse, and help brands grow their business, especially coming from tech and CPG realm. So happy to be here. Thank you.
And Craig, joining us from LA.
Joseph, Bonnie, thank you always for including me here. As you see behind me, I've got the Chase Lantern. I joined Chase a couple of months ago in their business banking out here in Beverly Hills, 25 years in specialty banking, and now I'm really focused on lifting small business through lower middle market companies, and that's a span of deposit, treasury, and lending, which is really where our focus is. So hopefully looking forward to hearing from everyone today. Thanks.
Thank you. Farah. Farah, you're muted.
Good morning. So I'm going to keep my camera off because I'm near the mountains and the transmission isn't always good. I'm based in Switzerland, and I'm one of the strays that Joe has brought in. I met him last year. And I work in life sciences, mostly with early stage companies and therapeutics.
Thank you.
It's nice to meet everyone.
Igor.
Hi, all. Thanks for having me. I'm Igor, the founder at Roya. We use machine learning to automate how brands see their return on investment across all of their marketing channels. And we give a very clear playbook for them systematically to maximize their revenues through spend allocation.
Thank you. Kyle.
Good morning, everyone. Kyle Barrios from sunny Colorado this morning, outside of a coffee shop here. So glad to be on again and meet new folks. I'm a ex-Deloitte from New York and recent angel here with Rocky's Venture Club out of Denver. Great to meet everyone.
You as well. Mark Fleming. Hope you're in.
Robux. We're an AI-powered marketplace that helps the world's 5 billion social media users document their lives. In short, it's the Uber of photography with AI.
Yeah, calling in LA. Welcome. Patrick.
Hi, everyone. Good to see everyone. I'm based in New York, and I'm a lower middle market investment banker. Work for Paddock Capital Markets, so we help with M&A from the sell side and can help from the buy side as well. Raising equity and debt. Love working with founder-backed businesses.
And welcome. Ian, always good to see you. Calling in from Toronto.
Yes. Good morning, everybody. So I'm Ian Garnays. I'm the COO of Virtual Film School. We're an online school for influencers. And we just had our best week ever. And I have to say that it was basically Bonnie and Joe were kind of responsible for connecting me with the right party. So there you go. More later.
Fantastic. Wow. See you. Pendleton.
Had to unmute myself twice. Really nice to meet everyone. I was not expecting this to be so intimate, so that's super cool. I'm based in New York City. I come from a family of entrepreneurs, which led me to working primarily with Founder on the personal wealth side. I'm in private wealth at Morgan Stanley, but I'm starting to dip my toe into some angel investing. So taking my Morgan Stanley hat off for a second, thought it'd be super helpful to learn from some great investors here.
And they certainly are. Tino.
Hey everyone, my name is Tino Go. I'm the founder of Baru. So what we're doing is we're deglobalizing manufacturing because the long distance freight and warehousing consumes 40% of the industry's revenues. Our first industry is cabinetry. It's an $18 billion industry that we're reorganizing to save all that freight and warehousing. And this is a kitchen being installed in Wyomissing, Pennsylvania. And so I'm documenting it as we go. So since we launched, actual and pending sales are about 600,000. So we're raising a seed round if anyone's interested. Thanks.
For you, Perry. Welcome. Oh, you're muted at the moment.
You're muted, Terry.
Okay, good morning, everyone. Terry Carlone, I'm co-founder and CEO of a company called Vidient. We've created a technology platform using whole person health approach to prevent and predict the onset and severity of diseases and help people maximize their wellness.
Thank you. So, did I miss
cool
anything? Yeah, that is.
That's cool.
So I hope I didn't miss anybody. So, Len and Joseph, Joseph, I think that's the first time I've ever called you Joseph. Feel free to introduce yourselves and then tell us about the psychology of investors and what to look out for.
Well,
and what
my full name is Benny Joe, to be proper.
Whoa.
It's a good Okie name, so I go by my middle name. Yeah, I got to this. It's been a long journey, and I just stumbled onto an article when I was in college about why wealth stays in European families through more generations than American families. And it was a fascinating, and I didn't come from money, but I was sort of like that kid that was on the outside looking in. We had some family friends that I grew up with that were entrepreneurial families, multi-generational, and quite successful as a result. So it was always a fascinating topic. It just wasn't my family. And so I started down this path and a finance career, 5 years right out of college with E.F. Hutton, and then I went to the buy side with what became a laboratory for study, continue to study and apply this thinking. It was a firm founded by an old money guy from old San Francisco family, and he entered the business in mid-60s, started his own firm in 1970. And it became what was recognized as the boutique multifamily office in the Bay Area. And the bank in Liechtenstein came calling and bought him in 1988. I joined in 90. Then when my boss died, I took it over and ran it from 93 and for 20 years until I moved to Austin, Texas. So it was having both studied it and interviewed all the best professors on the subject and various angles of the psychology of wealth, gender biases and in decision making, and psychology of philanthropy, and a whole variety of things. But then I got lucky and stepped into this firm that was both old money in its history, but we were right there at 3000 Sand Hill, and we had some of the central players of Silicon Valley that before the internet commercialized and all hell broke loose. And that was so then we had a lot of new money clients as well. And it was just a laboratory to study this and apply the learnings from my readings with real situations. Old money, new money. The wife inherited it, the husband inherited it, the wife created it, the husband created it. Intergenerational dynamics, and how do you navigate? I've negotiated post-nuptial agreements, prenuptial agreements, second marriage, vesting schedules, all sorts of different things. And it's from that journey that that I've accumulated a bit and have spoken about it. And many people have asked me to write a book on it, but I would just rather talk about it in forums like this.
And we're always happy to have you.
Yes, and I
Awesome.
remember your trilogy of, webinars still. I keep mentioning it, especially the third one is amazing. Like you read that, you reiterate it, like you'll get clients. It's that good and simple.
Welcome, Zarin. Introduce yourself.
Yes.
Oh, yeah.
Hi, I'm Zarin. I'm based in Switzerland. I have a banking background and currently I focus on strategic partnerships and business development, mainly in finance area and also e-commerce.
Oh, thank you. So Glenn, take it away.
See, I met a bunch of you previously, so good to see those faces that I recognize and conversations we've had. Patrick, you should send me a note. We've got about 25 teams that are in M&A, and we're looking for bankers right now. So I don't know your bank. I'd love to get to know you guys better. We probably
Definitely
have
would
5
love
serious
that.
contenders in need of banking. My background is largely as an entrepreneur, so about a 30-year career as an entrepreneur, over a dozen startups launched. I ended up with 3 IPOs along the way. After the first one, which is a pretty substantial IPO, I ended up forming a family office. I was in the Bay Area at the time, made a lot of really dumb mistakes. I was 29, didn't know, like Joe, didn't come from money at all. And unlike Joe, didn't know anybody with any money either. So made a lot of mistakes, lost a ridiculous amount of money, but thankfully not all of it. And I'm pretty good at making it. And so some 30 years later, I was working with I wasn't really working with them. I was hanging out with some family offices and at an event, and got this stupid idea to launch a fund. And that's where Quake was born about 7 years ago. We now have 8 funds. We have 300 plus investments. We're looking at our next fund launching in Q1, Q2 of next year. So we're kind of taking a beat, catching our breath and getting ready for that. But my background is mostly on the entrepreneur and now venture side. And I should also mention, before I ever launched a fund, I'd done 112 actually direct investments into startups. So I've always been a very heavily active early stage investor, to the chagrin of most of my family office.
So tell us what you invest in, what your focus is on.
Well, that's a great question, Bonnie. I've always been, Quake, is a generalist. I have a really strong opinion about, so I got a lot of opinions. I got nothing but opinions. Joe knows this really well. But I've been through 3 really hard downturns. So have you, so have Joe, so have a number of people on here. And the one thing I've seen is that you need to have diversification if you're going to go into venture in general. The other thing is most of the juice lives in the earliest stage of venture. I want to be careful not to offend anybody who might be on the call who focuses on stages. I don't, but the earliest stage obviously has most of the yield if you look at the big outcomes, but it also has all the risk. The latest stage has very little risk, but much less yield. The middle stage sucks altogether. If anybody ever wants to get into that with me, I'm happy to do it. But I have had a long thesis about playing early. I do incredibly well at it. And, maybe that's a little bit arrogant, but regardless, I've done very well at that. And I think I have an understanding of how to do it. And so we tend to play really early, but with a very generalist perspective. We try and bring advanced, what you would think of as well-vetted technologies into markets that haven't been disrupted. So we look for very big problem sets, lots of buyers. I don't mean customers, I mean companies that will buy your company. So we look at ag tech, industrial, logistics, manufacturing, transportation, these big old line industries lacking modern disruption. We look at bleeding edge areas and pull those technologies into those markets. That's a big part of the thesis.
Oh, thank you. So they got the meeting. They're about to walk into the room with the investors. What do they need to know? What are they not aware of? And what do they need to do before they get there?
Yeah. Well, Joe, I think you were going to kick off with the kind of the broad perspective and the view, not from venture, I guess I would put it, right?
Glenn and I've done these with Bonnie in the past, and we like to just ham and egg it. And the only planning we did was to sort of, as Glenn just said, to me to frame a little bit of the sort of a foundational work, and then Glenn can pick up on the specifics of how to look inside the mind of an investor you might be pitching, whether it's an angel or VC. So. And Bonnie, I don't know whether it's appropriate to pull up that slide. I think I walked you and Glenn through, or whether that's an appropriate thing, or I can just verbalize it. What would you prefer, or what do you think the crowd would prefer?
You're welcome to, Joseph. You want to give him sharing rights, screen sharing rights?
You should have it, but if not, I'll make sure.
Yeah. And this is what I'm going to show you. This is the content of recorded webinars I've done, and sort of the think of this as the overview of what the book that people want me to write. And it's just the sum total of my experience in really studying and analyzing people's psychology. Can everybody see it?
Yeah.
Yes.
We called this originally, when we created this in my old firm, the psychology of wealth S-curve. S-curves are popular to communicate a concept. And what we found is, again, you can see the age and net worth. There's no data in there because everybody's different in where they're at in their own S-curve based on their age and or net worth. So you can't really plug in specifics here. The only thing I would say, if you could plug in a number, that age demarcation line where the color changes or the slope of the S-curve starts plateauing and flattening out, give or take 70 years of age. But that is a really heavy-handed generalization. So I wouldn't apply it. I've seen people in their 40s and even 30s get to that point. And it has also nothing to do with their net worth, although there is some generalizations that based on where their family wealth and what their lifestyle and they're accustomed to, as to what their net worth might need to be before they could really go through that inflection point of going from the accumulation phase of their life and their investment objectives, which I hate that phrase. It's their intentionality. So it's what we found is that people in the accumulation phase, they have a general behavior pattern and motivation as a result. But once they get to a certain point, they shift. And the things that become more relevant for them are in that definition, what we call legacy, where they're caring more about their family brand, their personal brand, the image they leave behind or establish for the subsequent generations. And this is where some of the tactical things that they start focusing on more, that's more relevant than just making more money during their accumulation phase. And one of the contrasts that I like to put forth is the most glaring example that I've experienced is Larry Ellison. And I have a kind of I have 1 degree separation from Larry Ellison. I've never met the man, but my boss knew him fairly well. And in fact, when my boss died, his 25-acre estate in Woodside, his widow, my boss's widow, sold it to Larry Ellison. So if you've ever read about the big Japanese Shangri-La that Ellison built in Woodside, that was my predecessor's estate. But this is a guy that's worth what, $100+ billion, and he's still in the accumulation phase because his behavior reflects that. He's passed by what the best I can tell from, again, 1 degree of separation. He hasn't reached legacy yet. So again, it has nothing to do with age or dollars. It's always their behavior is a reflection. And then if many of you, excuse me, was there a question?
Yeah, I just wanted to interject that he's the founder of Oracle, for those of us for the people who
Oh,
don't.
sorry. Yeah, sorry. And then many of you may be familiar already with Maslow's hierarchy of needs and motivations, but this is a really important lens to apply to the people you're talking to, because people are defined by this. And let me give you some examples here. You know, the psychological safety is the foundation. Everybody's got to have that secure. Otherwise, they become quite tribal, and the veneer of civility disappears. And you think of gang warfare, you can see gang behavior, you can see some of the real crude human behavior. It's because in large part, those folks they're still in that bottom phase of their pyramid. Their life and their life's journey has kept them there for whatever reason. Then once you get past that, it's safety, security, home, food, things like this. After that, once you've got that established, you get to community, belonging, identity with some community. And then it's ego, self-esteem. And then at the top is the self-actualization, which is the highest form of human motivation. Now, one of the things that, again, going back to that prior slide, the amount of money, it doesn't matter. When you look at somebody there's something called sudden wealth syndrome. And what oftentimes happens when somebody wins the lottery, or a professional athlete gets that big contract, or somebody inherits a big chunk of money that they didn't know about, or they knew about but they never really had access to, their life changes dramatically economically. You'll see them change their community. That does, just because you've got money doesn't push you immediately up to self-actualization. This is where the Tiger 21s occupy. That was formed by sudden wealth people in New York. And they just want to hang out with a whole new crowd that also had the same level of financial status. So they changed their community. They wanted to belong to a different community. And then once they've established themselves, you'll find some of those folks be the loudest bidder at a live auction component of a good deed charity function, because they want to show their community they're got enough money to overspend and overpay for something that they could go buy for a quarter of the price someplace else, right? They want to project their wealth loudly and demonstratively to their community. So again, the behavior defines where they're at. And sometimes, again, you can shift. Yes, you can go down without a doubt if your life circumstances changes. So, and the process of moving from community to self-esteem can be quick. But ultimately, going from self-esteem or ego to self-actualization is the hardest leap. But what happens is, when people do, this is sort of what happens. That is the evidence that they're in their legacy phase. And so when you're talking to investors, when you're getting exposure to them, it's important, just as Glenn will touch on, make sure you're talking to them and not presuming, A, they're terribly smart about your subject matter or investing in general. Just because they've got money doesn't mean they know what they're doing. In fact, the opposite, you can presume and be more accurate than not, that they're probably projecting more experience or significance in investing than they actually have. That's what at least has been my experience. But those that have moved to the legacy phase of life, then they're going to care more about, again, things that have not a lot to do with beating their chest over the fact that they're on the cap table alongside Sequoia on this really hot deal. That's not necessary to them, right? They're caring more about, maybe this is where impact investing starts showing up. They may have donor advised funds, maybe they're very active in charity, et cetera, et cetera. So, but do it in an authentic way. You know, one of the fellows I studied in studying the psychology of wealth, I became a philanthropy consultant for our clients. I was helping our clients give a lot of money away. And I did a deep dive with a guy named Paul Sherbish, who was a professor and was sort of the academic expert on the psychology of philanthropy, why people write checks. And from his work over 25 or 30 years, that I think it was at Boston College. A lot of his work is what informs the curriculum at the I don't know if the top educational track, if you will, undergrad and graduate degree for managing nonprofits is taught at a university called IUPUI, Indiana University, Purdue University, Indianapolis campus. And their curriculum, you'll see Paul Shervish's fingerprint all over the books and the curriculum and the like. But Paul identified of the last year, it was roughly $500 billion were given away by wealthy people to nonprofits. And that's been a number that's been around that number for the last several years. So it dwarfs how much they're putting money in startups and venture and that sort of stuff. But he identified that 2/3 of the total dollars given are motivated by what he labeled consumptive philanthropy, meaning that it was largely ego driven. What's in it for them? Oftentimes it's getting your name on a wall, buying your way onto the board of directors of the Met in New York or some other cultural institution so you can show that you're more cultured, but you buy your way onto the board. Things of this nature are what he puts in that bucket of consumptive philanthropy. 1/3 of the dollars given are true altruistic in their intent and tactics. And so this is the slide that I wanted for all of you to just capture, because it really does come down to when you're thinking of and talking to investors, and reflect back on investors you've interacted with in the past. Use this as the lens and look at their behavior, not what they claim, not what you perceive them to be, but really what their behavior has been. And you can put them very quickly in this S curve with the Maslowian overlay. And that will then shape your conversation with them. What is it that they're really sitting there for? They may say they're an impact investor, but it could be just ego driven. It's truly not self-actualization, as an example. So then I'll hand it off to you.
Sure. So I'm gonna depart slightly and look at the. So when I was coming up, first of all, I think it was Carol was the data scientist. So hi, Carol. That's sort of my background as well. If you look at most of the companies that I worked with or that I launched, they're data science focused. My personal background was in sports. So when you're in sports, you do a lot of, you watch film. If you play at a high level, you watch film and you look for trends and tendencies and weaknesses, to be blunt, in your competition. And you look for things that you could expect, anticipate in your matchup. And that's how I attack business broadly, whether it's meeting with investors, business development, customers, it really doesn't matter. I attack them all very strategically. And so when I started, and I've really gotten a look behind the curtain now running a venture fund and having some really candid conversations with other people who run venture funds, which is probably the biggest eye opener. But when I was even running companies, I was really doing analysis on the VCs or the capital that I was going to be meeting with. In my case, a lot of the early part of my career was meeting with large family offices, and then that evolved. But there is a psychology inside every one of those organizations. So that's kind of what I'm going to touch on a little bit. So just a peek behind the curtain. If you're meeting with a fund, you can do basic research to learn about the fund. You can learn whether they have multiple funds. Is it their first fund? Have they previously had a different, worked as a managing partner in somebody else's shop? But if you've got a fund manager who themselves is launching under their own shingle, they're launching their own fund, and it's their first fund. Let me give you an example. That fund manager has a very different psychological perspective than somebody who's on their second or certainly their third fund. Okay. for one thing, they have to prove something, and they have to do it very, very quickly. So in order to raise their next fund, unless they're independently wealthy, which I got to tell you, most VCs really aren't. They're using other people's money mostly. They eventually get to be very wealthy, but if they're in their first fund, they probably aren't, unless they came, again, they were a tiger shark. They basically were a pup and came out of that. But if they're launching their first fund, they're looking for things that they can basically see monetization within 9, 12, very early windows, maybe 18 months on the outside, not 8 years. That doesn't mean they won't still invest in deals that have a 7, 8 year timeline, but they're going to really sit up and take notice if in your presentation there has the potential to be an earlier exit, as it were. And that's something they need, because they're going to then mark up. And by the way, it doesn't even have to be an exit. That's actually a really important element too. They're just marking up their book. So if you can go out and raise additional capital or have some other kind of event that can validate a valuation higher than what they came in at, they're going to mark that up on their book. When they mark it up on their book, now they go out and talk to new potential investors or even existing investors who are giving them capital, and they look really good. And it's much easier to get the big follow-on check to launch. By the way, that's the other thing. If you looked at like Joe's pyramid, apply that same general notion to how funds look, except turn it upside down. The first fund is about this big. The second fund is this big. The third fund is bigger than the screen, right? So they need to get, when you talk to a lot of these VCs, they're trying to get to their third fund. That's what a lot of the conversations are. That's where the real juice is, because the way VCs largely make money until they make real money is off fees. And so they need, there's a lot of VCs that wouldn't really enjoy this conversation. I'm speaking as a guy who had a family office, and I'm a reluctant VC, I guess is how I would put it. We don't frame our fund the same way most VCs do, so we don't necessarily get along with every VC in that regard. But if you look at how most funds work, they're making money off the fees. They get a percentage of the money under management every single year. And so the bigger your fund is, the better car you drive. Okay, that's a nice way to put it. The nicer, the bigger mortgage you can carry, until they get some exits and make real money. So when you look at an early new fund manager in their first couple funds, those are some of the things you really have to be thinking about. You have to think about how you can make them look better. By the way, they're not the boss of anything. They're reporting to their money. And that's the boss at the end of the day. Well, maybe that you can call it the customer, but it's a very unique customer relationship. So anything you can do to make that relationship more successful, to give them the ability to think at least they can mark up their book in a reasonable window of time, that they can then broadcast that. Those things are going to be very, very helpful to moving the needle. The other thing is transparency. So if that fund manager, and Joe and Bonnie and I have talked about this in general, as an entrepreneur, this is a ridiculously important thing anyway. There's a direct correlation between those companies that have detailed updates and reporting and success. And it's, in my opinion, I write ridiculously detailed LP updates, like 15-page long every other month updates, which is just ridiculous. Those are not for my LPs, nor should your updates necessarily be for me. They're for you. Like, that's an exercise you need. That's why they work. That's why business plans work. Business plans don't work because you're giving them to a VC, which nobody wants anymore, apparently, which is also stupid. But the business plan is for you and the update is for you. But in this particular instance, when you provide that kind of transparency to a fund manager, or even in some cases angels, we can talk about, there's a very different psychology between an angel, a super angel or super high net, a family office, and a venture capital fund. They're all different. Right now, I'm talking about venture capital funds. But a venture capital fund, if they know that they're going to get transparency from you, what do I have to do with my LPs all the time, my investors? I have to turn around and update them. I don't want to have to chase that information. Matter of fact, I'm not going to chase that information. I've got way too many deals. I'm not going to do that. So I'm going to take the squeaky wheels that are giving me both asking for help, but also kicking me information are the ones that I'm kicking back to my in family office investors or my foundations and so on. So the people in the world that actually have real money that are hearing about companies are hearing about the companies that are reporting upscale to me. So it's doubly important that you send updates to your investors because unless you tell them not to, they're sharing that information upstream. And they're also, when you first meet with them, before they ever give you a check, they're trying to determine if you're going to be additive or subtractive, if that's even a way to put this, but if you're going to be additive to their equation of raising more capital, because for most of them, I hate to tell you, that's what they're thinking about. And so with venture funds, you want to be constantly thinking about the psychology. Now, with a later fund, they have slightly different perspectives. They're probably now at this point, they're very focused on the ultimate victory. They're focused on exit. They've probably learned a few things along the way, to be blunt, unless they've had a lot of experience at some other fund. Most early fund managers can be snowed over pretty easy with exit language. And what I mean by that is you can go in and tell them how you're going to exit the company and you have no real clue how you're going to do it. Neither do they, by the way. And so they can be blown over pretty easy. The fact of the matter is most people can tell you how they're going to exit their company, but they have no real idea how to execute on that. A third time fund manager has already gone through that a bunch of times, and they are going to be much more interested and much more focused on the nuts and bolts of how you intend to take that company from building something neat to a liquidity event. And getting into the real granular nature of how you're going to navigate that transaction at some point and who the potential parties might be. Not just a bunch of jazz hands going around, which tends to be the first fund manager will let you get away with that. So when you're talking to the first fund manager, it's transparency, it's updates, it's a near term, not necessarily exit, but monetization markup event becomes ridiculously important. There's a transition in the second, but certainly by the third, they're really focused on the exit and the full, I would say the bigger ticket is a part of that. And that's where I kind of go with the venture side. And if we want to get into angels, you and I, Joe, can kind of just, and Bonnie as well, because she deals with them all the time. We can kind of ham and egg the family office and the angels, because again, very different mentality in my experience.
Yeah, I wanted to add one more thing because you were talking about, keeping your investors updated. I've heard investors say this so many times, especially when companies are running into problems. The investors might be able to help.
So true.
And better to address it early on than wait because you don't want to share bad information. They're your partners. They have skin in the game.
Well, we all have teams too. Every one of us has a team that probably we haven't heard from. And when we hear from them, they're raising money. That's like the worst possible thing you can do as a founder, for so many different reasons.
And this, going back to my time as a philanthropy consultant for our clients, and helping them get involved in angel investing in the 90s, that was the single most important issue for my clients, is that they get taken, people with money get taken for granted. The nephews that need to be bailed out, or the grandson that needs to wreck the car, or whatever. They're always got people come to them with their hand out. And it drives them absolutely batshit crazy. And the nonprofits are just as bad. They just wrap themselves in worthy cause and sell an emotional transaction with their handout. And that's the single greatest thing I witnessed from my clients. The older the money and or the larger the money, the more that is the defining criteria of what's important to them. It has nothing to do with making money. Remember, the $500 billion was given away and they were losing all of access to that capital largely, not entirely, but largely. But being taken for granted is absolutely critical. When they write those checks, if they're going to be an early stage investor, there's a qualitative motivation. There is a psychological return they're seeking. And that the dividend is that communication. They want to be there for the journey. They don't want to be taken for granted. They want to hear from you, good or bad, because that's why they did it. That's their principal ROI they're seeking, regardless of what they say. If they're truly trying to act like a venture capitalist and they're truly a financial buyer where financial return is their motivation, and they continually reiterate that to you, then that's a very naive angel investor. I don't care how much money they have, because the reality is when they're investing early, as Glenn was pointing out, that may be where the returns are, but it's also where the greatest risk is. And the likelihood of them succeeding by doing it themselves in a small handful of individual deals is absolutely asinine as an expectation if they're truly beating their chest as a financial buyer and they're a serious investor, but they're doing it in a concentrated way in early stage. That's an oxymoron. So anyway, I just want to reiterate that singular point, is that the psychology is critically important to navigate if you're approaching individuals, wealthy individuals, and not just somebody that made some money at Dell or Intel or whatever else. And they're doing it for the social aspect of being part of an angel group and say they're an angel investor. I mean, that's more community, if you will. If you go back to that Maslowian pyramid, they just want to join a different community. But this transparency issue is, and everything Glenn said is spot on. The value of transparency and the exercise of being transparent pays multiple dividends, both in your execution and your focus, but also on delivering that psychological dividend to those that may have written you checks.
I wanted to give Ricky a chance to introduce himself. He got here late, if you'd like to. And see if anybody has any questions so far, or points that they'd like covered.
There's got to be something out there.
Yes. Well,
yeah, no, I was very curious because you did discuss, Glenn, the differences between the viewpoint of family offices and angel investors and VCs. And I often get the sense with startup founders that they're focused completely on VCs, and they don't recognize the other opportunities also from strategic investors. What do you think about the importance of strategic investors?
Oh, wow. That corporate VC and strategics are hugely important. And particularly now, I do want to make one quick comment. I thought you were going to head towards family offices, and there's a couple quick comments on that. One, there's an adage, like if you've met a family office, you've met a family office, because they're all completely different. And I think there's a ton of truth to that. I think there's a ton of truth in many areas where that can apply. But the other thing about family offices, are ridiculously hard to find. And I know personally good friends of mine that spend 6 figures a year, well into 6 figures a year, to hide to basically remove their digital footprint as a family office, which I think is ridiculous personally. And I've had these conversations because the whole point of building the damn office is to actually find opportunity and concierge services and a variety of other things, but it actually exists for a reason. I don't know what the hell you're paying people for if you don't want to actually look at stuff. You don't have to do a dang thing. You can say no. It's a really short word. It's not hard, but that's the general view. So finding family offices is difficult. Now on the strategic side, Joe, did you want to add to that? By the way, I know you got it. Probably opinion.
Yeah, I mean, this issue of family office, it's sort of like the label venture capitalist. There is no metric, there's no course you have to go through, there's no standard by which anybody has to adhere to call themselves a VC. But the same thing is true of the family office, and that's a label that's gotten grossly diluted.
Massively.
Grossly diluted. It's fashionable to say you've got a family office. That in many, many cases is ego. It's just ego. A proper definition of a family office from my professional experience. The first family office in the United States was the Wilmington Trust Company that was formed just to manage the DuPont wealth. And that's a really important thing to keep in mind, is that a proper family office, and from my experience, is where the family has hired professionals to manage their wealth, right? You outsource it to people that actually know what they're doing. If the patriarch or matriarch that made the money is the one that's also making the investment decisions and saying, we've got a family office, and by the way, talk to me because I'm the head of our family office, that's not a real family office unless they have legitimate investment experience. But that's become such a fashionable label that you can find a family office, but the reality is it's just an individual that wants to wrap themselves in that label and elevate the community that they're claimed to be part of. So be very careful even when you identify one, because the more discreet they are, that's partially why you have also professionals and fiduciaries and accountants and lawyers in there, is to provide that barrier and the discretion, so that you're not hounded by strangers, right? Talk to my people. If you've got people, you may have a family office or the formation of one. If it's the people that created the wealth who's also making the ultimate decisions, that's not a family office, in my opinion. That's just a wealthy individual with ego as a defining criteria of their motivations.
Yeah.
Again,
I
unless
also,
that person has investment experience.
yes, and I mean, I agree with all of that, and also a lot of like the definition even differs in nuances from country to country. A lot of private bankers create their own little shop and call it a single family or multi-family office. They will only manage publicly traded securities. I mean, it's like venture capital. They will not go and invest in some random whatever the team is. No, that's not, because I come from that world. They do US treasuries or I don't know, Templeton Bond Fund, PIMCO this fund, BlackRock.
Right,
It's even
right.
absurd. Within the official description, venture capital does not even exist as an asset class. It's like fixed income equities, alternatives, REITs, private equity. So it's very important what that family is actually doing. And again, I think US and to some extent UK is still the strongest countries in terms of family offices being very big and sometimes open to investing in venture capital, distressed debt, private credit, private equity. In other parts, it's not non-existent, but less so. It's like typically the legacy business of publicly traded securities.
And we have Andrea here, who does manage a family office. If she has anything to add, I wanted to mention that.
Yeah, Andrea, anything to add?
Yeah, I do. Sorry, I'm also rushing out, but that's correct on all. But I think it's there's a lot more to that as well. Sometimes it's defined, not sometimes, but another factor is how much, right, is either under management or how much is investable capital. I think friends and I in the space have been going back and forth on a lot of that. But ultimately, I think I would love to hear. I don't know what else to add to that, but I think a lot of times with all of this, then what, right? So I think understanding, it's so true, right? The saying is, once you know one family, you know one family. But the same could be said of a lot of, I'm sorry, I'm just repeating what Glenn has already indicated.
I do want to go back
to,
I do want to go back to what Ian, because he asked me a question I didn't answer yet. I realize that. Ian. So I do want to go back to that. I would just say that there's an interesting dynamic too between single family and multifamily. And I want to be careful here, because this is my opinion. I've had both a multifamily office and a single family office myself. I did not do well with multifamily, so I have a strong opinion about that, but that's my bias and my broken personality, okay, my broken psyche. But as an entrepreneur dealing with the two, what I've seen is a difference in the way they attack deals. So with a single family office, a lot of time there's domain expertise. And there is, even to Joe's point, even when managed by a professional team, a lot of time they recognize the power of the matriarch or patriarch's network, and they recognize they can leverage that. And so they tend to stay in a particular lane. Not saying this is universal, but there's a lot of that situation in single family. Multifamily, you rarely will see that. What you have a tendency to see that I don't like in multifamily, at least again, as an entrepreneur, my experience is that if you put a happy bow, a spin on it, like right now it'd be AI, for example.
Right.
If you put the right moniker on the deal, it's going to be more likely to be something they can package and show to each of the families and feel good about. And the deals that I tend to see coming out of multifamily offices tend to be like the what I used to joke about, you could brag at cocktail parties about.
Yep.
Those are the types of deals. So again, very strong opinion, may not be right. That's just my perspective and what I've encountered trying to pitch deals and sitting in rooms looking at deals through a multifamily versus single family. Going back to the question about corporate venture, I think it's a huge part of your strategy, but you also have to be very careful with it. I'm talking not so much as, because again, most VCs have no freaking clue about this stuff. I'm talking to you as a founder who's been through this many times. So when you do a CVC deal, you are basically starting the move towards monetization, liquidation, exit, etc. Not saying you're going to go with that particular corporate venture partner, but you are certainly starting to think about those things. And you need to be careful when you do that transaction. I'll give a very specific example. One of our companies, I won't name names, but one of our companies is in the ag tech space, and they have three of the biggest investors in that space: the single largest producer of pork in the world, one of the biggest breakfast sausage brands that you would see in every grocery store. All of these people are investors in the company. One of them, a little over a year ago, about a year and a half ago, wanted to invest a significant amount of capital, and they wanted a ROFR, a right of first refusal. They wanted the ability to have the first shot at either the next line of investment or acquisition of the company. Now, that's normally a dead stop no, because it's going to basically put you in a position where you cannot solicit multiple deals, what we call stalking horses, where you know, like in horse racing, where you can basically move against another horse. And so you want multiple horses running to the finish line for a transaction if you can, multiple offers. However, in this particular case, the founder, who's very young and has a very fast moving business, but is not at the stage he wants to sell, knew very well that he wasn't going to sell within that window of time. They wanted a 1-year ROFR. He knew he wasn't going to sell in a year. He looked at it and he's like, this actually gives me not only additional capital, tremendous networking and firepower on the distribution side. It's going to actually signal to the world that I'm interested in the potential of an exit. And in fact, what ended up happening is he had 5 suitors come forward, the again biggest in the world in his space, that have started a conversation about acquiring the company. And that started before the ROFR expired. So that's an example. And he, guess what? They didn't retain a banker basically until like 2 months before the ROFR expired, with, 2 months of diligence and preparation and everything else. And the ROFR ends, and now they're out there talking to people for a potential exit. That's, an example of how you can use that to your advantage. I think if you just bring in a single strategic investor, no right of first refusal, no weird terms in the deal, just a straight, it's actually a signal to the rest of the investors. Now, there are some people that don't like CVCs. I think they're idiots. Again, I'm very direct. I'll tell you exactly what I think, and I'm wrong plenty of times. My wife would tell you that gladly. But a CVC signals to the world that somebody who really has a domain expertise way more than the typical fund manager or anybody else, way more than not necessarily analysts are really kind of interesting cats. But if you take most people in the funding arena, they don't know much about any particular domain. A corporate venture partner typically does. They probably vetted it at some level back into the organization. There's a lot, we co-invest, we run a fund with Deutsche Telekom, and there are some groups like that that will not put money into something unless they see it moving into their channel eventually. That means that they have done some real vetting of its applicability to their customers, the market opportunity size, et cetera. So if you're somebody like an Andreessen, a Sequoia, a later stage fund, you should look at that and go, damn, okay? So I think corporate venture, I'm a huge fan. If you look across our portfolio, it's a massive part of the follow-on activity that we put on it. I know I went long there, but I do think and I think particularly right now, what I've seen in the last 9 months is that's been even though they kind of scaled back, that's still been a very good market, at least for our startups, to pull capital. It is harder to get in the door. I acknowledge that. It's trickier to find. You typically have to have a little bit more traction. The easiest way I've seen to get to corporate venture partners is to work with one of the customers they are already working with and then work back through that channel. That's been the way that I've historically done it.
Thanks. Very, very helpful.
Can I ask? Let me add a couple things before we get to Terry. Sorry, Terry. Let me add a couple things to that. One is, as you might expect, everything he said was spot on. I mean, it was brilliant, Glenn. I'm not sure they really appreciate how brilliant that was.
Well, where's my wife?
Equally as important is going back to the transparency issue, because corporate VCs, unlike traditional VCs, do have a fiduciary mindset, and they have to report to the CFO or the board of directors on where they might be investing. And if you're not transparent, you're making their life, they're just going to avoid you. Wow. So that's a really important component if you're entertaining or have an opportunity, or that's going to be part of your strategy, is you damn well better have good reporting, because that is going to be a major barrier for them saying yes or no. And then going just back very quickly to add to the family office conversation, for entrepreneurs that want to pitch, I would recommend against pitching to multifamily offices for many of the same reasons that Glenn talked about. They're risk managers. They're thinking of career risk. They're thinking of what's the upside for them to bring something to their clients, plural. And unless it fits into the almost a FOMO sort of headline validated strategy, like he said, AI, there's no upside for them to be creative. There just isn't. And so that's why they do stick to the branded products, the branded funds, the branded fill in the blank, because, it's that old adage years ago. It was a very famous phrase. It's a bit dated now, but back in the decades ago, it used to say that nobody got fired by buying IBM. It wasn't the best computer, but by God, you could buy an IBM mainframe and you don't have career risk in the IT department of the corporation, because it's IBM, right? And it's the same psychology. But single family offices don't have that constraint. Even if it's a proper one where it's fiduciary led, they've got outside professionals, they're only serving one client. And part of their job is to continually earn and retain the trust they've got with that family, is to be creative. I'm guessing this is some of the work Andrea does with the family she interacts with, is to be out there and be creative, because just sitting there and doing and being in all the branded product like everybody else is, they don't feel that special. They want to be creative and thoughtful and show that they're a little bit different from their friends that are just buying IBM, metaphorically. So anyway, Terry?
Yeah, I had a question about approaching maybe corporate offices or family offices. So our company has a decided for-profit aspect, right? Our technology platform in healthcare, but we're starting a nonprofit to help us with the broader reason we set up the company in the first place, and that's to help underserved community, help rural areas where doctors and everything aren't available. How would you, I guess we're looking to get some donations for that. And would you look to companies that are already in the for-profit healthcare area and looking to help help wellness generally in society and help underserved community and pitch them the nonprofit? And how psychologically would you approach them on the nonprofit aspect of something they may already touch a little bit on the for-profit side of their business? Does that the question make sense? Or?
I followed you. So I'm always weaker. I'm just going to preface this. I'm always weaker, Terry, on deals where I don't have personal founder experience and I'm relying on the companies I've worked with. So we have a lot of companies that fit that profile, but I personally had never done any not-for-profit type of work. We also have a couple foundations in our investor pool that have invested in the fund, and I've learned a lot from those people. So I think it's really a fascinating question, because what I've experienced with that is that I've seen opportunities to go, most for-profit corporations still have some not-for-profit component in if they're a large organization. Most municipalities have some, in states and even federal, of course, have programs to assist and drive money into entities that can help underrepresented, underprivileged communities that maybe are being overlooked in some way, whether that's for healthcare or something else. So I would absolutely be attacking those in local markets. I wanted to, and I'd probably do it in unison. What I've seen work really well with some of our founders, I don't know, one of our founders who gets around a lot, Ofo Azuyu, is with Who's Your Landlord? And this dude is you want to talk brilliant. That's a brilliant guy. He has figured out how to, in your case, for example, he's working in the landlord-tenant relationship, but in your case, he would be going to perhaps the medical provider, the corporations that are servicing the medical provider, and it would be going to the municipality the medical provider lives in, whether that's a state or city, and he would be looking at the Economic Development Council, in his case, in those markets, and he would be trying to work all three at once, basically almost with each other and against each other. So he would be saying, start with the healthcare provider, let's say a hospital, because I'm not exactly familiar with the business, but he would start there. He would look to see who the big distribution and service partners that are really relying on that hospital's growth. And he would ask the hospital for connections into those potential partners. He would start talking to them. He would then leverage those two partners to get into the municipalities and the state organizations. And he would ultimately bring a conversation of all those players together for how they could drive opportunity into the community. And they will effectively create their own little feeding frenzy and drive each other faster than they otherwise would individually. That's what he does. And again, not my expertise, but I've seen that work quite well. I do think there's an opportunity. I will say that those types of actions tend to be longer. If I'm building a startup, one of the reasons I didn't do a lot of that is because that takes 6, 9, 12 months, and I can have a funding conversation done in 3. And so from my perspective, it was efficiency. So I would put 15% of my energy over there and 85% of my energy on the more straightforward attack when I was doing that sort of thing. And for me, it wasn't even 15% because I quickly realized it was going to be a pain in the ass, and I was real good at raising money. So I just went the other way. But I do think that there are, again, he's an example, and I could probably name a dozen more in our portfolio that that's their primary way of raising capital, and they've done really, really well. I'm trying to think if I know any people who are funding that way right now. Again, foundations, Joe, you might have some thoughts, but foundations and not-for-profit funding tends to just take longer, is my experience with that.
Okay, no, thank you. Appreciate that. That's good advice.
Sorry.
No, you go ahead, Henry. Yeah.
I was just going to add to what Glenn already said, which is some of these nonprofits are actually looking to put a fair amount of capital into missions because they're a little bit more mission driven as opposed to market one. I know some groups that have started to work with nonprofits for these moonshots, especially in the biotech space. So I think that that's, I'm starting to hear that as a fairly innovative way of working, as opposed to going to VCs, who's, biotech is risky, and there's, it's very a binary nature, so it's a little bit harder for them to, but I think nonprofits and moonshots, that might be a good way to go.
Yeah, just to reinforce some of Glenn, and certainly to touch off on or top off what Andrea said, there's something called mission related investing, which is, I think, what she was specifically speaking to, which is where a foundation whose mission is aligned with what you're working on. Let's say it's to improve the environment is one of the things they give to nonprofits. A foundation does. That's part of their mission, is to support the environment. They can take part of the corpus of their foundation and invest in green technology companies under what's called a mission related investment. And so you can unlock the corpus and not have to be a 501c whatever to try and get some of their charitable donation dollars to support your effort. And I've been shocked at how few foundations actually understand that MRIs even exist. That's what it's called, an MRI, mission related investment. But if you can find a foundation that's mission aligned with what you're doing, and on their own website, they'll speak to MRIs, they do MRIs. That's a very thoughtful and progressive foundation, and somebody worth approaching, because that's a sophisticated tactic to begin with, which means their team is relatively sophisticated and creative, if you will. And going back to, again, just to also lean in a bit more on what Glenn said is, again, as usual, that's why we do this, is that I agree with everything he's had to say, and just going back
We
to
can agree with each other. Maybe that's a bad thing.
Yeah, I know. We need to get better at that, I guess. We need to find something we disagree on. Oh gosh, now oh yeah, going back to the nonprofit versus for-profit. The one is, yes, it's a longer duration conversation, without a doubt, because oftentimes people inside foundations aren't that creative financially. They come from the nonprofit mindset. And so that they're going to need to see other people, like what Glenn said, his example was other people moving in on the idea, and then they'll join in. So they're sort of followers in that context. But you also run the risk of wait, you've got a for-profit and a nonprofit. What are you approaching us on? Which one? And so you run a risk of confusing the message, in other words. Is the only point I wanted to add. That's something I've encountered on more than one occasion, is, again, and that's always a function of the relative sophistication of the people running the foundation dollars. Is the messaging can get pretty messy, and it's too much mental work for them, and so they'll just naturally back off, even though it might be the greatest thing since sliced bread for what they're doing or what they claim to want to be doing. So
no, good points. Thank you.
Yeah, the other thing if I'm going to spend 15% of my energy or whatever it works out to be on that sort of work, I'm also going to probably build a chapter within that is working on SBIR or some kind of related small business innovation research or some related grant opportunities. Look, I'm a huge fan of non-dilutive capital. As a founder, I was always a big fan of that. It's a pain in the ass. It's hard to get, but I will say this about SBIR grants. If you guys, any of you are chasing them, they're a pain to get up front. But once you get in the door, they're pretty damn easy to keep. And it's a pathway from basically $250,000 up to 1.5. And it's a pretty damn easy path to 1.5 once you get in the door. And if you're doing mission-driven things, it's actually, there's probably going to be something available out there. Now the timing might not work or whatever, but if you're not looking at SBIRs, you should. That's another thing we push a lot of. Well, I wouldn't say we push, just naturally a lot of our founders are chasing those anyway.
This is fun.
So does anybody else have a question or a comment? Don't be shy. This is for you to participate.
Hi, I can give it a shot here. Just wanted to talk a little bit what you all have to say in terms of exit readiness. And there's two ways to look at it. Some folks say, we don't want to know about your exit strategy. It's too early. Others say, well, if you're not thinking about an exit, then you're not thinking about how to give me back my investment. So where's the middle line there, or the middle ground that you can touch upon?
Go ahead.
Yeah, I think I'm going to again go back to my experience as a founder, though we certainly have a lot of teams dealing with it as well. But I think it's a lot of how you couch that, right? I think if if a founder comes in and tells me they're going to IPO, I'm like, now I've done it 3 times, but I'm like, no, that's not gonna that's not gonna happen. So I think you kind of set the table. Don't oversell the exit, but you do want to leave it out there. You want to let them know that that you've got a strategy for it. These are the key players that you believe at this moment early in your journey are going to be the likely candidates. There may be some twists along the way that open up some other channels or avenues, but these are going to be the candidates, and that you're going to build strategically towards that off ramp. I think that's more the way I would attack it. Now, when I was talking early in the conversation, I was saying, get specific. Well, I'm not expecting you to say with specificity who you're going to talk to. I'm not talking at the company. I'm saying within the company, what divisions within the company, any of that sort of thing. But when I meant specificity, I'm talking exactly that. I think these are the industry players that have been very active in the space over the last 3 years. This is how much money has been invested in acquisitions in this space. Or there's been a dearth. There hasn't been very many acquisitions in this space, and it's timing for 3 years from now being a really big push into that. So that's more what I'm talking about. Strategic dialogue about your thought process on what the market looks like moving to an exit. That's what I try and bring into those conversations. And if you do that, you're saying that you're a partner that is calculated. That's what I'm looking for when I'm talking to somebody.
And again, I hate to keep agreeing with Glenn for Christ's sakes, but there's a gentleman that I encountered years ago, and I can't remember his name, but his business is to help people raise money. But that was his tactic. His playbook was go do your homework on where there's been acquisitions in the space. And then see the investors that were the investors in the companies that got acquired.
Exactly.
And now you've got a good targeted investor because they've already had some success. So it's a way to reverse engineer if you want to do some cold calling to investors, but you're building a really strong case when you reach out to them and say, look, you invested in XYZ company and they were bought by ABC company. Well, we're in a similar space, tangential. This is our value proposition, yada, yada, yada. I'd love to talk to you. Or if it's not that, if you're not talking to one of those investors that had a successful exit in a similar tangential space, it prepares you, as Glenn was saying, for people just generic investors you may be talking to say, look, there's been these numbers of acquisitions in this space, and whether they're still going to have an appetite for what we're doing or not, I don't know. However, there clearly is an appetite. There is a roll-up strategy that has taken place in where we're operating. So it just shows that you've put some strategic thought to it. And whether you're claiming you're going to be bought or, don't ever say you're going to IPO. Don't ever say that.
I agree. I agree with that.
You're showing how naive you are. Oh my God, that is just the silliest thing. If an entrepreneur says that to you as an investor, try to walk the other direction because it's just such a naive claim to just throw out there in a conversation. It's just patently silly.
Run the other way.
Run the other way. Yeah, because they just showed their hand on how naive they are and how they're trying to trigger some greed feeding frenzy in talking to you as a potential investor. So just run. That's just patently silly. If you do IPO, those are windows in time, and who knows whether there's going to be a decent IPO window. I personally think that I'm fairly confident that there's going to be a robust secondary market for private securities, so an IPO won't even be necessary. There's already the plumbing getting built, so I think you can take that completely off your conversation and reference that. So look at whether it's exit can come from M&A, and there's the plumbing being built for a robust secondary market in private security. So the exit will be available if we put our nose to the grindstone.
And you can look at some of the platforms. I know you're talking about there's a bigger push for that, Joe, but even now there's some secondary platforms like Hive and others where you could look to see what similar companies are out there that are already getting referenced on those sites. I do want to shift gears real quick, because I know we're going to run out of time. I want to say something before we lose the time. It seems like a departure, but I think it's a really important thing if we're hunting capital. And Joe and Bonnie, you can weigh in and tell me if I'm wrong about this, because I tend to think in some cases I'm a contrarian on the venture side. Well, I know I am, being on some panels, but one of the things I am very militant about is I'd much rather get a referral from a founder, one of my existing founders, than from even a co-investor VC. And I'll tell you why.
Wow.
My co-investor, yeah, that's probably not what everybody necessarily wants to hear, but let me explain the rationale. Bonnie, you're an exception. Joe, you're an exception. That's not me just saying that. We've got a relationship that's separated from being just co-investors. Just co-investors, when they send me a deal, I always worry. I'm like, great, they're pawning off their crap on me. There's no incentive. They just need to get that company funded. There is zero. They don't give a damn about my LPs or about my fund. Matter of fact, they're pissed when I do really well relative to them. I know that's not what everybody's supposed to say, but that's just human nature, and that's who they are. And the reality is, when my founder sends me a deal, and I don't think this is true, but this is the mentality within most founders, they're like, effectively thinking they're giving away some of my money, like they're taking my money that would otherwise go to them and it's going to somebody else. That's number one. So that's a very hard chasm to get across. The other thing, if they get it wrong, it reflects really poorly on them. Again, I don't tend to react this way because we've got a lot of deals and there's stuff's going to go wrong. But I think that's I've had these conversations with our founders. I know damn well that's what the mindset is of the founders. So when a founder makes a referral, and again, it sort of depends where they live in the hierarchy of the children within the fund, or we love our children, but maybe not exactly the same way, right? There's some that we like more than others. That's just natural. But if they're a well-respected founder, not necessarily doing great, but if we think that that's a founder who's doing the X's and O's and really doing the work, and they refer a deal, way more powerful for me than some fund that we co-invest with. Maybe I even go to sit on panels and know them, but I don't, we're not especially close. That doesn't mean jack to me. And I don't think it does to most fund managers either, to be honest. I know they like to pull from within their network, and I know there's a lot of commentary about that. But if they really think about the motivations, I can't imagine that that's the case.
Yeah, and this is something I have been hearing, because sometimes VCs on certain panels will say that sometimes their best deal flow comes from other founders that they're already invested into. But just as as we hear all of these things and we hear all these advice being dispensed of, I wonder how much of it becomes a bit of a, like, I might, if I'm happen to be a founder, I might push another founder to get me in the door, and there's a little bit of it. Just I think there's a lot to be said about what's super authentic and organic versus the ones that, because of hearing advice, because I think more people are hearing the advice. When you ask for money, you'll get advice. And if you ask for advice, you'll get money. So people are starting to just kind of go around acting as though they're asking for advice, but it's just to get to the money. So there's something very, so yeah, now there's just more to sift through. And so yeah, that's just, but everything you guys are saying, I see it on the ground floor in the Bay Area. But I will say one thing, multifamily office, we're not that. But I do have some friends who work in that space, and sometimes they say they have to go through the door knocking process, meaning, so if you come to a single family office and we say no, then that's it. Unless we're making a recommendation to another family, that's it. Whereas multifamily, it's been said that because they have so many clients, and if they happen to be discretionary clients, they can go down the list of their clients and you might have a shop. It's a bit of a numbers game at that point. And hopefully they're good gatekeepers, but I would just, say that there's still some possibility there of maybe seeking funding if you can, be in cahoots.
Andrea, I think you're exactly right. I was a little heavy-handed in my characterization of the two. The only thing what I would add to you is that the smaller multifamily offices are going to fall within the category of what you described. But if you're talking about Northern Trusts or some of the other ones that are legitimate multifamily office business models, that's really who I was characterizing. And again, as expected, Glenn, that is so spot on. And what comes to mind for me, I always default back to my prior career as a money manager. And your comments just reinforce what I just find so detestable about venture capital is this need to get validation from somebody else before you take a look. The optics of requiring a referral. I mean, we did our own securities research. We built portfolios. We turned the rats were in where the idea. I sourced all my own stocks because we did our own securities research, because we had good data and we knew what we were doing. I didn't care what my colleagues were doing. Whether somebody told me, hey, you ought to buy this stock, we bought it. Oh, hell no. They're just pitching their own book. There's so many perverse incentives. Either misery loves company, or it's what Glenn was touching on, is that they're pushing their crap to you, trying to elevate the valuation, for crying out loud, just to try and blow some hot air into something they probably regretted buying to begin with. And so it's to me one of the single greatest flaws in how entrepreneurs source capital is this issue. And that is, to me, a reflection on the preponderance of people calling themselves VCs that literally don't know what they're doing. And that's why we get such FOMO behavior. They need referrals because they find confidence in somebody else, because they themselves know that we're not that experienced and they seem to have more experience than we do. So I'm going to trust their opinion. Well, they're putting their trust in the wrong goddamn place, because most VCs do not know what the hell they're doing. Period. Full stop. And if somebody wants to challenge me on that, let's go.
I have a story relating to it. We only have a minute left, and I don't want to take up the minute if anybody else, because I'll stay a few minutes longer and tell you the funny story, and it involves a very well-known investor. If anybody has one last question, because we have a hot minute left. Or if you guys want to share how to get in touch with you, that's up to you.
Sure.
Yeah, I can just throw it in the chat.
Yeah. We always ask first. We don't just give away contact information.
Bonnie, your crowd's a good crowd.
It is a good crowd. And we will invite you back in September, October, if you have some time.
We got to find something to disagree on, Glenn.
That's true.
We need to find a debate topic.
I'm sure we'll delve into that.
Maybe
safe.
Just take counter what you would normally say. Just take one opinion.
I'll just be devil's advocate. Yeah, sure.
And I want to thank you all for coming. And if you want, after we stop recording, if you want to stay a minute, I'll share the story about the investor.
Oh, yes, please.
I'll stop recording.
Thank you, everybody.
Thanks, everyone.
Go.